Hello and welcome to the September 24 Buy-to-Let Mortgage Market Update. My name is Richard Pennell from the Mortgage Home and we are your buy-to-let mortgage experts. What have I got for you this month? Well, I've got 4 pieces of content. As always, I start by discussing the Bank of England, the interest rate policy, what's likely to happen, and of course, what's the impact on mortgage rates. Now, I always get asked on such a regular basis, how can I improve my credit score? Because we all want the best and lowest rates out there. And to do that, you've got to keep your credit score as healthy as possible. So I've got tips and tricks on how to do that in that piece of content. Now, if you're looking to raise finance, but you have obstacles, issues, challenges, then have you considered second charge finance? If you've not come across it before, then dial into that bit of content and I'll explain all about second charge finance and how it might just help you release the money you need to do that next project. And finally, are cheap insurance premiums too good to be true? Now, you need to know the difference between reviewable and guaranteed premiums, as it just might save you £10,000. I'm going to show you an example later. So if you've got life insurance or income protection, then you will either have guaranteed or reviewable premiums. I suspect you won't know. So after this, make a note. I suggest you write down to remind yourself to dust that policy off and see what type of premium you have, because it could save you a lot of money. Now, in this piece, this is Market Watch. I'm going to be talking about all things interest rates and moving on to mortgage rates and what are the implications. So first of all, let's start with the really, really good news. Finally, on the 1st of August, we had the Bank of England to come off the fence and drop rates from 5.25% to 5%. So the question is that the trickle before the flood? Are we going to see multiple interest rate drops? Well, to answer that question, we've got to look under the surface. We've got to go back to that meeting on the 1st of August because there are 9 committee members. And this is how much on a knife edge it was. 5 of the 9 said, yes, let's drop rates down by 0.25%. 4 of the 9 said, no, it's a little too early. They wanted to be a bit more prudent. That's how close a call it was. Now, you might be saying, because I talk about inflation so much every month, it's so important to this conversation. And the Bank of England's main objective was to get inflation down to 2%. And they use interest rates, moving them up or down, as a blunt instrument to achieve that 2% target. Now, you and I now know that inflation target has been hit. That 2% has been hit in May, again in June. Okay, it's gone up slightly in July, but that was anticipated. It was expected. It is not a shock. It's not heading back north again. It is a little blip. So we're not concerned about July. So essentially, the Bank of England have done the job. So it's a done deal. Come on, Bank of England. We should be now dropping rates even more. And actually, when I now turn to the banks and building societies and other lenders, they are thinking that at the next meeting, 19th of September, make a note in your diary, that the Bank of England are likely to drop rates again. I think that because they're starting to drop their mortgage rates a little bit more. They did start in July in anticipation of that 1st of August drop, which is brilliant news. We all welcome that with open arms, but rates are dropping again. Now, there could be another thing going on here. Yes, it might be that there's an expectation that rates are going to drop a further 0.25% on 19th of September. But in addition to that, we've also got that the impact of that 0.25% drop back on the 1st of August, whereby we saw with Rightmove and Zoopla, these are the 2 big boys out there, all their data was saying that activity, transactions are up by 25%. And that, of course, is going to feed through not only to viewings, offers in on properties and sold signs going up, but ultimately into mortgages. So the lenders want to position themselves to get a bigger slice of a growing pie. Now, so let's get back to the concerns, however. So yes, we've hit this inflation figure of 2% month on month. But here's the concern for those 4 committee members I mentioned a little earlier, because you've got to get under the surface of this inflationary figure. Because when you do that, there's inflation for various sectors within the UK economy. And some of those sectors are really, really dragging their heels. And that's why there's a concern by the Bank of England. And one of those in particular is pay inflation. And of course, we've got this new Labour government coming. And what have they done? Within weeks, agreed significantly higher pay awards to various public sector bodies than the Tories were prepared to do. And that's likely to have its ripple effect. Now, a really, really good example of the nervousness of the Bank of England, because the impact is you then have, as an employee, you have more money in your pocket than you otherwise have thought. You've got more disposable income. Therefore, you spend it more readily. That creates a surge in demand. And therefore, the suppliers of various products and goods and services, what do? They put prices up higher than they need to do. And that is how inflation starts to creep back up. And that's why the Bank of England are really nervous about the pay inflation figures. And the example that we've all been seeing, maybe we don't realize in this context, but the Gallagher brothers, our friends Noel and Liam, we know, don't we? Anyone on the planet, you've got to be living under a rock to not know that they're reforming as Oasis. And so everyone that wants to get a ticket have been joining that long queue on Ticketmaster or wherever. The face value price is 150 quid. You get to the front of the queue and what's happened? It's not 150 quid, is it? No. It's 450 quid because the guys pulling the strings at Ticketmaster can see the level of demand and think, do you know what? We think we can get away with higher prices. So Noel and Liam, come on, boys, do the right thing. You're not short of a few quid. Let's get back to face value pricing, because if that was replicated across the UK economy, then we would, I can assure you, start to see inflation creeping back up. And guess what? That means that interest rates are going to get stalled and will not come down at the pace. So really interesting scenario there with our Oasis friends, and how that has a real life potential impact if that was widened across the economy. And then the impact on inflation. So in addition to that, lenders are starting to drop rates again, which is really good news. I'm now seeing, I think there was I looked yesterday, about 5 or 6 different buy-to-let lenders on offering 5-year deals under 4% now. So when I did my last update, I don't think we had any lenders offering deals starting with a 3. And now we've got about 6 lenders. So that is the direction of travel, that rates, of course, are getting cheaper. And I do expect that to continue. But I want to also talk about average interest rates, because that is useful in a certain context. So the typical average 5-year fix right now is 5.34%. And that's if you are getting a buy-to-let in personal names. Now, if you have a buy-to-let in a limited company, that's higher. That's 5.85. So we've got about a 0.5% differential. Now, why is that interesting? Because if we go back only 1 year, and actually let's go back to 2016 right up to 2023, the differential has been at least 1%. And all of a sudden, we're now seeing that gap narrow and narrow and narrow. So if you're a limited company landlord where you've got mortgages in your SPV, then that's really, really good news. And why is that? Because I've said on a number of occasions on these updates when we talked about limited company mortgages that I do think that these lenders are profiteering. Yes, they've got to do a little bit more due diligence on a limited company application, but does it justify an extra 1% or more on the mortgage rate? I've always said that was not the case. And finally, the rates are starting to get closer to those personal rates, which is really good news. And one of the reasons I think that is that we're getting more competition in. Go back 2 years, and there were no high street lenders, no banks, no building societies would offer limited company mortgages. And now Leeds Building Society joined the party. Leek did, Family Building Society, Mansfield, Nottingham Building Society. And only in the last week or so, Metro Bank have also come in, and they're now offering limited company mortgages. So expect to see more lenders joining this market. It's going to get wider, creates more competition, and I think that differential is going to drop even further. So that's really, really good news. My forecast is that mortgage rates will continue to drop the rest of the year. We're going to see at least one drop from the Bank of England, if not two, by December, and that you'll see that saving passed on through mortgage rates. However, the question is, do we sit on our hands if we're coming off the end of a deal right now? Do we wait until the rates have dropped even more come Christmas, or do we jump now? And that's a question we're asked quite a lot back at the Mortgage Home. Look, I've got to give you a generic answer. Obviously, each answer is specific to your circumstances. However, my gut feeling is get those savings now, because if you're waiting another 3 months for rates to drop, and then you put in an application, it could be another 2 months before you're onto that new rate. So you could be talking 4, 5, 6 months before you actually see those savings. In the meantime, if you're on SVR, then you're losing money to save money down the line. So it could be a false economy. So my gut feeling is certainly speak to you, engage with your broker, get those new rates right now, and start the application process and get them saved. If rates do drop while the application's in, your broker should be able to access those even lower rates before you've actually completed, so that you don't miss out. So I hope that's been of use to you. And like I say, if you do want to have a review, there will be under this video a link to our online diary. Just book some time in, have a chat, and let's see if we can help. In this piece, I want to talk about improving your credit score. Why should you be bothered about that? Well, if you want the best rates in town, you've got to have a healthy credit score. So my advice to you is to get hold of your credit report, not your credit score. Get your credit report. And you might want to write this down. There's 3 different agencies I would recommend: Experian, Equifax, ClearScore. All these guys offer free credit reports. Most of the lenders use these agencies to access your data and ultimately make decisions on whether they're going to approve, decline, or offer you less than competitive deals. So it's in your interest to take some responsibility over the data that's in this report, because the first thing you should do, and by the way, I suggest you do this annually, make it an annual review to look at your credit report and look at the data within it, because so often when our clients do that, there's errors in there, there's mistakes in there. And it quite often, if you don't do this review, the only time you find out there's an error or a cock-up by the credit provider is when you put an application in and you're getting declined. And the feedback from us as brokers is, yeah, your credit, there's something wrong with your credit score, and you're up in arms because you don't know anything about it. So be on the front foot. And it's part of your getting your ducks lined up. And being mortgage ready, so that when you're good to go with a mortgage application, you already know that your credit report is nice and healthy. So there's a few tips here. The first one is around moving home, because there are a few pieces of credit that or data that's in your credit report that quite often are overlooked when you move home, because it doesn't seem on the surface to matter when you've gone from address A to address B. One of those is your bank statements. The vast majority of us, we're online, aren't we? We don't get paper bank statements. When did you do that? Is it the 1980s? So you don't get them through the post. So you don't think, oh, I need to update my bank about my change of address. But you do, because that bank account is on your credit report. And if it's still linked to your old address, it can be an issue. Likewise, being on the voters roll or electoral roll. Not only is it a legal requirement to be on it and on it at the right address, people forget when they move house. See, they don't think, oh, I've got to change electoral roll to the new address. They might wait until that card comes through the post 3, 6 months, 12 months down the line. Be on the front foot, be proactive, get yourself on the voters roll at the right address as soon as possible. Because here's the thing, you putting a mortgage application in, and your mortgage application paints a picture, tells a story of a variety of things about you. And then the underwriter looks at your credit report and there's a mismatch. You're saying, I live at property A, your credit report or parts of it is saying they live at property B because of these things that have not been updated. So at the very least, there will be delays while we untangle this mess and we try and give some clarity to the underwriters. And trust me, it's not as simple as saying, oh, I'm sorry, the applicant forgot. I can assure you it's more complicated than that. We have to provide a range of documentation, and quite often these are not at hand. So look at those things, certainly if you've moved home recently or you're about to. Now, credit cards is another thing. Look, obviously they're prevalent. Most people out there have got a credit card. And there's this old saying, isn't there, that if you want to improve your credit score, get a credit card. Well, I want to dispel that myth straight away, because the first thing that happens when you apply for your credit card and you get approved, what happens? Your score drops. It doesn't increase, it drops. Why does it drop? Because the credit card company have given you pretty much not quite a blank check, but a check for just, a £4,000 limit, £1,000 limit, a £10,000 limit, whatever it happens to be. And right now, they don't know how financially prudent you're going to be, how sensible you're going to be, or otherwise. So until you've made some payments back, your credit score actually drops. And then over roughly 6 months, as every month you start making your payments, your credit score starts to ratchet back up. And then it starts to improve over time. But it's not an overnight thing. So if you are wanting to put an application in tomorrow and you think, oh, I'll get a credit card today, don't do it. Stop. Too late. You need about a 6 months window to make any sort of positive gain on your credit score. Now, second point on credit cards is about your utilization. In other words, how much are you using of your credit card balance as a percentage of its limit? Now, if you're paying the full balance off every month, doesn't matter, that will still add positively to your credit score. If you're making lump sum payments, again, that's great. I'm talking about you guys that are making the minimum payment. In other words, every month you're rolling across a big chunk of that credit card balance to the following month. Now, there's a bit of a sweet spot here of up to, I would say up to about 70% of the credit card limit would be perceived as healthy and therefore will add to your credit score every month. Once you start to go well above that figure, that percentage, and you're heading towards 85, 89, 90%, and of course higher, then it actually has the reverse effect. It will start to take away from your credit score. So do everything possible to stay down around 70% of your credit limit or below. And here's the thing that I have seen so often, and it's such a false economy. You get people that are up at 90, 95% of the credit card, and they think that's fine because, look, I've not exceeded my limit. I'm simply managing things. And they've got savings. And I'm not talking about contingency savings. I'm talking about money's own over and above that. And they're earning 2 and 3 and 4%. Because you know what? They like to see on a statement every month that we've got 2, 3, 4, 5 grand, 10 grand, whatever it happens to be. It gives you a warm feeling. What a false, what a lot of rubbish to be earning 2%, 3% over here and paying 15% on your credit card balance. It makes no sense whatsoever. So take the money out of your savings, pay off the credit card balance to bring it down. Not only is that saving you more in interest, but as I said, if it gets you down below that 70% figure, then it's actually adding to your credit score and getting you in that healthier position. Now, financial associations, what on earth do I mean by that? Well, this is where, let's say we've got a couple, whether they're married, you're together, you've got some form of credit on a joint basis. Is that store cards? Is that a loan? Is it a joint bank account? And then you part company. you get divorced, you separate, you go your own way. So you disentangle in every way, but you've forgotten to do the joint bank account. Because do you know what? Well, I don't use it anymore. The ex-partner, the ex-spouse, yeah, they're still using it for their things, but it's not to do with me anymore, is it? I've gone my own way. What you haven't done is untangle that piece of credit. So on your credit report, you are jointly responsible for it. So guess what? Your ex-partner who's got a bit of an overdraft on that bank account goes over the overdraft limit for a month or two because they've just missed something, forgotten something, or whatever's happened, gone over the overdraft limit. Guess what? You get tarred with that brush. You get seen on your credit report as being over your overdraft limit. So if you have party company, maybe it's happened in the past and you haven't even thought about it, get your credit report, go through all the open bits of credit, and if it's finished, get your ex-partner to open a brand new account or get your name taken off that bank account, and then you can go to the credit card company and have that financial association removed. Could be the best thing you ever did. Now, final thing is on defaults. We all have a certain level of pride, and sometimes that can come before a fall, where you have an argument with a company where you've got a form of credit with. And it might get to a point where you want to teach them a lesson, and so you don't want to pay. You don't think you owe them any money, or you think they should have reduced a certain balance, or whatever it happens to be. There's an argument. And to teach them a lesson, you stop paying. Or the reminders that come through the post, you just put them in the bin. You will show them. What's happening in the background is that ultimately that credit company that's lent you the money is going to not only class you in arrears, but ultimately turn it into a default. And that will, of course, impact you on any sort of credit that you want to get for anything up to 6 years. So my advice is, if you've got any issues with these companies, even if you think you've paid, it might be worth just paying them what they're saying you owe, but then have your argument, then put your complaint in at the same time. Because if it turns out you're on the right side of being correct, they're going to refund you and everything's fine. But if for some reason they can demonstrate that you are incorrect, then because you've already paid the extra amount of money, your credit report is intact, it's healthy, it's not been smashed to bits. So you have to really, really take responsibility for your credit score, your credit report, and look after it and nurture it. It will then look after you in the future. Now, final thing, I just want to make a quick offer. Look, we have a link below this piece. There'll be a link to our online diary. If you're unsure at all about whether your credit report is healthy, unhealthy, what is it saying? I can't interpret it. Can I improve it? What are the tips and tricks? Send us a copy. Have a review with us. There's no cost. Send us a copy of your credit report. And as advisors, we'll have a look through. We'll give you some feedback. And maybe, you never know, we might be able to improve that score. And as I said, then you'll be in the right space to get the best deals in town. In this piece, I want to talk about second charge finances or second charge mortgages. If you've not heard of them, then let me explain. It comes into play usually when you are looking to raise extra finance. So this is secured against your buy-to-let property, of course. And it might be that there could be barriers. Now, usually your first port of trying to obtain this extra finance is through further advances. In other words, you go back to your current buy-to-let mortgage provider. Most of them will offer a further advance, but some do not. So that's the first challenge. Those that do, and you go through the process, it might be that you can't get the amount of borrowing that you need for that next project. So a further advance is not always an option for us as landlords. Now, it might be that you, as another option, you want to remortgage to a new lender. So you're going to move from lender A to lender B. But what if you're tied in with redemption penalties? And some of those penalties can be significant, eye-watering figures. So Again, if you might want to avoid paying those redemption penalties, and again, this is where a second charge finance comes into play. It might be that since taking out the mortgage with your current buy-to-let lender, your credit score has deteriorated rapidly. Maybe you've had some bad fortune, maybe you've had some adverse credit, so now you've got a poor credit rating. And if you remortgage the whole debt to a new lender, you're going to get penalized for the full amount of the mortgage. Whereas if you can leave your main mortgage with lender A, and quite often you can, at the end of the deal, just move on to a new deal with a product transfer, and there's no credit check done. So even though you might have a poor credit score, you can still stay with that main lender and get good deals. And that's, again, where the second charge finance becomes really advantageous, because it's a standalone piece of finance. It's with a completely different lender. And so your main mortgage is protected, as I've described a little earlier. So there's lots of advantages of going to a second charge finance provider. In addition to that, there tends to be a lot more flexibility. So if you've got some maybe unusual financial situation, maybe it's about how you're being paid, maybe it is about loan to value that you want a little bit higher. Maybe you need to go slightly longer term than is normally allowed. Well, second charge lenders are really flexible when it comes to these things. They've got a lot of quirky policies, lending sort of policies out there that might just fit what you need. So second charge finance, really, really useful tool. If for those situations where you can't wait to the end of the penalties, you need to raise some extra finance for whatever reason, further advances are not appropriate. Like I say, maybe the lender doesn't even offer them, then get a second. Now, how do you obtain those? Well, brokers, mortgage brokers usually have the right approvals to do second charge finance. Not all of them, but so we do at the Mortgage Home. So again, if you're looking to raise finance, you think, crikey, yeah, I've hit a bit of a brick wall. I really could do with that extra 10, 20,000 now, not wait until the penalties end. But I didn't think I had all those options open to me. Then as a broker, we'll look at further advances. We'll look at second charge finance. We'll look at all the different scenarios that are open to you, and we can then advise you about which is the most cost effective. So if you think that is useful for you, if you think you want to understand a little bit more whether you can raise that extra finance, then there will be a link at the end of this page. Just book some time on. It's a free review, and we'll be able to tell you whether we can help. In this piece, I want to talk about, well, let's look at the headline. Should I pay £20 a month for the policy, or £60 a month for exactly the same policy? These two policies give exactly the same benefit to you, whether it's life insurance or income protection. There are scenarios where the premium will be £20 or £60. So you might be going, hold on, is there a catch here, Rich? Well, surely £20 is the answer, isn't it? Well, I wouldn't be doing a piece on it if it was as simple as that. The first thing we've got to understand is the difference between reviewable and guaranteed premiums. I can assure you, if you have a life insurance policy, if you have an income protection policy, it will either be a reviewable premium or a guaranteed premium. If you don't know the difference, I suggest at the end of this piece, make a note and go and dust off your policy and find out which you're on, because it could just save you thousands and thousands of pounds if you understand the difference and then know whether you're on the right one or not. Now, let me explain what these two are. Guaranteed premiums, as the name suggests, guaranteed. So when the insurance provider gives you a quotation and says, in this case, it's £60 a month, that means for the term of the policy. And you and I know, when you take out a life policy, it's not just for a year. You've normally taken it out probably for the life of a mortgage. It could be 25 years, could be till retirement, could be 30 odd years. And so the premium that's been offered on a guaranteed premium basis, the insurer says that £60 a month in this example will always be £60 a month. So here's the thing. Unlike almost any other piece of expenditure that you will have, whether it's utilities, overheads, food, we almost expect that those prices are going to go up year on year. This is the exception to the rule. That 60 quid will stay at 60 quid for 30 to 40 years. So, of course, down the line, 60 quid is probably a cappuccino is going to cost 60 quid in 30 years' time. So it will feel and will be cheaper and cheaper and cheaper for you as time goes on. Obviously, in addition to that, if it's guaranteed, it's good for budgeting. You know what you're spending. The premium will never change. So another advantage. Now, how does that compare to reviewable premiums? So I'm suggesting here, because I did an actual real life example, and this is exactly how it came out. On a reviewable premium basis, the price, and here's the clue, starts off at £20 a month. Now, as you say, if you just offered, do you want to pay 60 or 20? You can see how it, for certain advisors to put that under your nose and not explain, it would look extremely tempting to just sign up to the 20 quid. And indeed, that might be the best advice. But here's how it works. Here's how these insurers, again, for life insurance and income protection, they both have these options whereby it will start off at 20 quid, but then there'll be a clause saying we will increase that premium. Now, sometimes it's every single year. It's on your birthday. Happy birthday, your premium's going up. And that's going to happen every single year for the next 20, 30, 40 years. Sometimes it's for other factors. It's not just an age-related increase. The insurance company might also put into the clause, we want to increase your premium if our profits are dropping. If we're getting too many claims coming in, we want to come back to our customers and say, guess what? We're putting your premiums up. So there are those different examples of why premiums might increase when it's reviewable. So the question is, which should I pay? Should I pay the 20 quid and then see what happens in future, or the 60 quid, but know where I am? Well, we can answer that where we look at these reviewable premiums where they increase every year by age, because what the insurers kindly do is give us a table of what the premiums are going to be at every single birthday. So it's a simple maths question. So I've done one. I want to walk you through it. So I took a 30-year-old non-smoker, self-employed, who wanted £1,300 a month just to pay family bills. Should he have an accident or have a sickness, not being able to work? The way income protection policies work is that as long as your GP signs you off as being unfit to work, doesn't matter what accident you've had, what sickness, what illness, as long as you're unfit to work, you've got a sick note, that's the eligibility to claim, and the insurer starts to pay out the £1,300. And here's the thing with these things. Let's say you had a claim and you were age 30, and as you can see, the policy is to go to age 68. They would pay out £1,300 a month, and it's indexed, by the way, so it goes up each year with inflation. But they would pay you out every single month, every single year for 38 years if you could never go back to work. That's a high quality policy. So this is the example I'm using. And if we start with reviewable premiums, as I said on the previous page, £20, 68p a month. Guaranteed £61.55. Really tempting, isn't it, to take the £20.68? But let's see on the next slide what you're going to pay in aggregate over those 38 years. And now you see that over the fullness of time, on a reviewable policy, you'd end up paying 36,000 quid. With the guaranteed, you pay 26,000 quid. There's a £10,000 difference. So for reviewable premiums, you're going to be paying 37% more over the life of the policy. Now, which is best? We still don't know. Look, the point is, as advisors, our job is to make you fully informed, put the data and the information on the table, and then we can advise you because we need some context. We need to know your circumstances, your situation. And as advisors, we can say, do you know what? For you, reviewable premiums are the best way forward. Or actually, no, it's guaranteed. So the answer can be in all these things, it could be either. But here's the point. If you're on reviewables right now because someone put you onto what appears to be the cheaper policy to start with, but it goes up every year, or even worse, you went online and I guarantee you will not even know what type of premium you got if you went online to buy your policy. This is the advantage of coming to an advisor. And understanding that full picture and making sure that you've got the policy that is fit for purpose. So please, please, please spend 5 minutes at the end of this piece, dust your policy off. If you're unsure what sort of premiums you've got, what might it go up on year? Am I on the right one? Should I have guaranteed? Please put some time in to speak to Yvonne, our insurance advisor. There's a link below this piece. Click on. It's free. The advice is free. The service is free. So please, why won't you just take some time and make sure that you're on the right policy for you? And just to finish off with this last slide, this gives a link to our online diary. So if you did want to cut and paste it, you're more than welcome. And then type it into the address bar at some later date. Or as I said, it should be under this piece to click onto immediately, book some time in. Once you click on, there'll be either insurance or mortgage options, depending on what is the priority. And then we shall do our best to help you and put you in the right position moving forward. I hope that's been really, really useful content this month. Please give a like on here, subscribe to it so you'll just get updated each month when the next update drops, and then you'll be able to get it straight away. If you subscribe, you can also go back. We've got 4 years worth of content on there. So you've got a whole library of resource to access. That's free for you guys to look at as and when you want. Or if you just want to, if it's more complex, you're not sure whether it's an appointment, just ring the office, have a chat with the team, and we'll be delighted to help. See you next month.